First of all, thank you. Thank you, Nikunj, for a lovely introduction, very detailed, very elaborate. Thank you, Pranay bhai. Very true pleasure and honor to meet you. And Mihir sir, finally we meet, and thank you for, again, having me to speak here at the BCAS. It is my utmost pleasure to be able to have the opportunity to speak in front of an esteemed audience and to add value to any initiative that BCAS has. I've learned about BCAS and its activities, and I think it's wonderful to have such an association, and even more wonderful that the people who are running it take out the time for this social gesture. So, amazing, and very, very happy and proud moment to be here for Girik Capital. Um, as has been introduced by Mr. Nikunj Shah, we are a SEBI registered PMS and AIF with a 13-year track record investing in Indian equities. And I would like to just start by saying that when we were given the opportunity to present over here, we asked ourselves that this is such an ocean of a subject. It is so vast, right? There are so many ways to invest in equities. The wonderful names that come to mind when you talk about equity investing are legends like Warren Buffett, George Soros, Mr. Templeton, and the likes of so many more. But, at the end of the day, we can read all these books and we can read all these wonderful things about investing. But putting this into practice, why is it so hard to put it into practice? Why is the success ratio so low in investing? So no answers to this question, I can tell you. But what we've tried to do is to talk about a couple of very simple subjects from our experience and knowledge of managing public money in the last 13 years, which we hope can ring a bell with the audience, and we can hopefully relate to the audience when we talk about these one or two subjects. And largely, we've decided to talk about growth investing, and what are the couple of tenets of growth investing that an investor can keep in mind while entering into growth investing. What does growth investing really mean? Growth investing is simply investing in growth companies or growing companies. Now, fortunately, India is and has been a growing equity market. If you look over the last 5 years, 10 years, 20 years, 30 years, it's been a wonderful place to invest money. And, as while introducing myself, Nikunj Bhai would have mentioned that I have worked in different parts of the world. I can tell you India is by far the most exciting. It is by far the most exciting place to work from an equity market standpoint, because there are so many pockets of growth, so many wonderful companies, as the great late Shri Mr. Rakesh Jhunjhunwala, who all of us have so much deep respect and regard for, said, there's a buffet out there. There's a buffet out there. You choose what you want to eat. So, on that token and that note, I would love to start this formal presentation. And, we'll go slide by slide, and I'll try to talk a little bit about the philosophy behind the subject. So you already have an introduction to Girik Capital. And, given that I have limited time, I'm not going to dwell on this too much. We are a SEBI registered PMS, and we have a 12-year track record of running Girik. I think more importantly, what I'd like to share in our experience and knowledge is that having been around for 12, 13 years and doing this, you see many cycles. So the stock market is a very cyclical place. Prices go up, they go down. You have bear markets. We have seen now 2 or 3 bear markets that have lasted 2 or 3 years, 2011 to 13. And then if you see from 2017 onwards, you are in a small cap bear cycle. Even until now, prices are well below 2017 in certain small caps. We've seen the COVID cycle, which was a very sharp fall, but a very meaningful fall. So once you've been through many cycles, you learn, you make lots of mistakes. So, when I'm standing up on this dais and talking to you, it's not that we know it all. I'll tell you, half of what we do is right and half of what we do is wrong. We make mistakes. We have to recognize those mistakes and move on. And we will talk about that as well. I think the 2 things that we're going to talk about here really are what we think we do well and what we think you can do well, and also what not to do. What are the things that one must absolutely ideally not do in the investing world so as not to get into a trap of wealth destruction? Okay. So I think one more salient point about Girik that I'd like to make is that we are pretty much 50 to 60% large cap investors. We invest in large leading companies and about 40 to 50% smaller and mid cap names, which are leaders typically and high high growth, but high quality companies. Um, you have there is already been an introduction to me, so I won't go over it, but rather I will talk about some of my co-founder, Mr. Varun Daga, who is also a well-known investor. And we started Girik together about 13 years ago. And Mr. Harshad Patwardhan, who is the Chief Investment Officer of Girik. He has vintage of working as the CIO of JP Morgan Asset Management and then Edelweiss Asset Management as the Chief Investment Officer. He's a veteran of over 25 years in Indian markets, both on the broking side and later on the mutual fund side as an investor. So this is the core team at Girik that is responsible for managing the money. I think I highlighted one point and I'll say it again. I think, out of all the countries we've worked in, India is the most exciting because of the growth. And we'll talk about that now, So let's get into growth-based investing and what it's all about. What are the secrets? So this is one of our favorite quotes. We love to have some nice quotes in there. It keeps the audience's juices flowing. So it is one of the great paradoxes of the stock market that what seems too high usually goes higher. What seems too low usually goes lower. So, rather than saying high and higher, many times one will find in the stock market that what is expensive, जो महंगी चीज है, वो और महंगी हो जाती है. मतलब things look like, oh, 40p, 50p, don't buy it, don't touch it. Sometimes you find after 5 years, the P's have gone up. The stock has gone up 10 times because the earnings has gone up 5 times. So I think that, this is something that we keep an eye on. And, we'd like to highlight that it's a real paradox. And why is this a paradox? We'll try to get into and explain as to why this is a paradox and how wealth can be created, keeping these things in mind. So what's the agenda? What are we going to talk about today? So within growth investing, I think we are going to talk about some of the traits of winning stocks. How does a stock become a winner? What are the key characteristics for wealth creation in a particular stock? What is it that results in the stock price going up meaningfully over time? Right. So we'll spend some time on that. Right. The second thing is, the point that we'd want to talk about a lot, and we have created several examples and data for your use, is how earnings growth. When we say earnings acceleration, we mean outsized earnings growth. Why is this a key driver for stock prices going up meaningfully over time? I can tell you in our experience, over a 5 to 10 year period, if you've had earnings of a company grow far ahead of the average earnings of the index, you will find that the stock prices goes up far more than the average earnings of the index. There are many reasons for this, and we'll talk about that and give some examples. One thing that, third point here is the use of P/E ratio in evaluating these growth stocks. Look, we'd like to tell you that after doing this for many, many years, a big learning is don't be fooled by a P/E ratio. A P/E ratio means very little. There's a legendary investor called great Radhakishan Damani. We've all heard his name. He gives this example of why prices in Malabar Hill are lakhs of rupees a square foot and they only go up over time. But prices in certain parts of the city don't go up over time. That's because they are in short supply. And that's because people with lots of money want to live in the same place. So, I can tell you that the same applies to great leading growing franchises. Typically, great companies trade at great premiums. Let us respect that. And I think that is a great learning for us in the last 13 years. So we are going to spend some time in demonstrating how high PE can become higher and low PE is not always the answer. So let us use this as a tool, not the decision-making tool. P/E ratio is one of many ways of evaluating a stock. And many times looking at an optically high PE fools us or lures us and says, let's stay away from this. And low PE ratios lure us. Without really understanding the business, we try to value the business. And that is a big, big mistake, is what we have found. So something to lastly, we'll spend a little bit of time talking about risk and risk management. You heard me say something. We are wrong half the time. I can tell you that there is no human being alive who can correctly forecast all the time. कल क्या होने वाला है अगर हम सबको मालूम था, we'd all be very different. Our lives would be very different. We'd plan our lives differently. What one can do is follow a process in forecasting. What one can do is try to follow a process in trying to understand, can this company grow? Can it grow many times the size? Can the earnings grow many times the size? Yes, then you have a high chance of success. But what if you are wrong? Then what do? One must understand risk and have some risk management tools to take an exit if you have made a mistake. So yes, recognition of one's errors is just as important as picking winners. If one can do that and redeploy their capital, one can generate meaningfully higher returns and generate much more wealth in a reasonable period of time. So this is what our agenda is for the day. And we'll now start getting into a little more detail. So we'll hit the first topic first, which is what are the 7 traits of winning stocks? Now, you can see that we've highlighted some of these points over here, CANSLIM. We are very inspired by this one US investor called Mr. William O'Neill. I would encourage everyone to read his book. It's called How to Make Money in Stocks. It's a wonderful book. It's a great playbook on growth investing. We as investors have picked the best of several leading investors globally. And I think we've tried to lay out some of the tenets of this CAN-SLIM method of investing, as it applies to us, as it applies to growth investing, and where you can benefit from it. So some of these traits of winning stocks we're going to talk about now. I think the first one we have already talked about. In fact, if you see the first 2 points, current big or accelerating quarterly earnings and sales growth, annual earnings increases, look for big growth. All this point is actually highlighting is that earnings growth is supreme. On this slide, to me personally and to Girick personally, these are the 2 most important topics. I think it's very important, especially in a growing market like India, to be able to identify growth stocks. Frankly, it's all about this. If one can get this part right, you have a very high chance of success, right? How do you get it right? Easier said than done. We'll share some examples. We'll tell you about how we did it in the past. But these are things that are very important. This is one of the most important points. And we're going to spend bulk of the time of this presentation talking about earnings acceleration and its importance for stock prices. Second point that I'd like to highlight, which is also, look, all these points are important. We use a lot of these tools. We have our own risk-based measures, our own process sheets, where we look for some things like this. So I'll go through all of them, earnings being the most important. N stands for newness. New companies, new products, new management, new IPOs, new demergers. Newness is a very big factor related to success in the stock market. The stock market, in our view, loves companies that are doing new and undiscovered things. Sometimes it also loves when there is a change in management or ownership. These are things to look out for, right? So when we say new management, what does that mean? I will give you an example, right? You all know about ICICI Bank, right? It was under, I would use the word an older regime. And there was a major management change or overhaul at ICICI Bank about 4 to 5 years ago. And one has seen how the earnings accelerated after that. New management can make a big difference to a leader. ICICI Bank has always been a leader in many sectors, but may not have been optimally run. People may not have been as ROE focused, as return focused, as growth focused. But the new management has done a wonderful job. I can tell you that newness really matters. New IPOs, high chance of success. Many examples of this in the last decade. DMart, Jubilant Foodworks, these were all first-time listings, first or second-time listings in grocery retail. In QSR, you have new companies show up like this, providing new products and services that people aren't akin to. It's worth a look. If the earnings are accelerating over there, icing on the cake, you have a very high chance of success. So newness is one important part to look for. Let's come to S. What does supply and demand mean, right? Supply means supply of stock. What to look for, what to stay away from. We try to look for companies where the supply of the stock is limited, right? So what does that mean? Look at the number of shares outstanding. A company that is constantly issuing stock, you have to be wary because they have much more earnings to service. They better be earning lots of money to service that earnings, right? Look at all the MNCs. Why are they wealth creators? They don't issue stock, they buy back stock. उसका सप्लाई कम होता जाता है। मालाबार हिल में एफएसआई नहीं बढ़ता। ये माइंड में रखना। Regular supplier of stock many times. So I'm not going to get into forensics here today. It's a different topic. We can talk about it later. But regular issuers of stock are generally dangerous companies, very generally dangerous companies. They could be rotating capital, right? They will show growth, but they won't show EPS growth, right? They could show growth in the near term, but you could be sitting on an Enron or a WorldCom or many such bombs. So you have to be very careful of supply. Large supply means large equity to service. Be very cautious. Put your risk management hat on, right? So that takes care of supply and demand, something we are big believers on. We don't like too much supply. Leader or laggard, I'll tell you, so this is the second most important thing to us today. Although we are going to focus on earnings and earnings growth, and we're not going to focus on what defines a leader, because what defines a leader is a very high quality company. There are many things that define a leader. Great promoters, great management, great accounting practices, proven over many, many years, great forensics, super manager of the ecosystem, superb working capital cycle. A leader is defined in many ways. Normally, it shows up in high ROEs or ROCEs, low debt, low to no debt. Very few companies are leaders, let me tell you. India doesn't have many test cases. So when we talk about earnings acceleration, make sure it's a leader. Otherwise, earnings acceleration does not matter, right? It can be a whimper. It may not prove to be lasting. Institutional sponsorship. So let's come to I. Institutional sponsorship is so important. This is something that people will realize over time. Sectors that have created wealth in India are very limited. Consumer, FMCG, banking, pharma, IT, select cap goods. All these are institutionally sponsored sectors. Mutual funds have high ownerships. FIs have high ownerships. Stay away from sectors in general where institutions are not going to invest. I will tell you, there is a plethora of sectors in India which have just not created wealth. Institutions stay away from them for many reasons. Newspapers in the past, several media companies in the past, paper companies in the past, low institutional sponsorship. Globally, they invest like that, the FIs. These guys are the movers of the market on the margin. Mutual funds stay away from certain sectors. They just don't go there, right? Your chance of creating wealth there is very limited. You may love it, but do others love it? You may be right on the fundamentals, but that P may remain low. For a P rating, you need the large investors to come in and put big dollars. You need them to make it Malabar Hill, right? So institutional sponsorship is very critical. Market direction. I pay least attention to this. Girick pays least attention to this. But in a bear market, all bets are off. I can tell you, in a bear market, value gets destroyed. Many times your thesis, everything may be right, but everything may go wrong. Just be aware of it. It's not. For us in India as a growing market, the growth has always bailed us out. You may make no money for 1, 2, or 3 years, but at the back end, when the bull market resumes, you make money. If your process is right, your research is right, the earnings have grown, you will make money. So this sums up the 7 traits of winning stocks. And I think this is a playbook for growth investing for Girick Capital. This is something we swear by and we continue to work on. So I'll move on to the next page. Another quote. So remember, there are no good stocks. They're all bad unless they go up in price. Never forget that, okay? Because unless you're making money, you're wrong. I mean, in general. Now, so, as we promised, we will work with examples in this text. And in today's presentation, we'll focus on earnings acceleration, on earnings growth, and why it's the biggest driver of stock prices, right? So like to make this more exciting, we put names on the table, which some or all of you may be well aware of, right? Hopefully most have heard these names. Jubilant FoodWorks is the Domino's Pizza franchise. Sun Pharma you have heard of. Relaxo Footwear is India's largest footwear manufacturer by number of pairs. Titan Company is a jewelry retailer owned by the Tatas. Bajaj Finance does largely consumer durable financing. Astral makes the Astral pipe, Bhaika pipe. Avenue Supermarkets is DMart, the operator of DMart stores. So all well-known companies, all have been meaningful wealth creators in the last 10 years. The idea of putting these slides in play for you is to share with you that what really mattered in the wealth creation over a, say, 3 to 5, 6, 7 year period was one factor, the earnings acceleration. One would grant that most of these companies are leaders. They're well managed. They have good earnings. When one set out to buy these companies, let's start with Jubilant FoodWorks. March 2010, upon the listing, it listed at an initial P of 60 times. Sounds obscenely high, doesn't it? Who would buy it at 60 times earnings? I mean, raise your hands. It's a tough one. But if one said, forget the P ratio, right? Let's forget the P ratio. The company for the last 3 years, the earnings had trebled. The volume growth was 20-25%. They were opening stores like crazy all over India. And Domino's is a well-known brand, isn't it? So it's not hard to diligence the demand for pizzas in India. If one had used some simple common sense at that time and literally drawn a straight line and said, look, can the earnings double again, double, triple in the next 3 to 5 years? Then my P ratio didn't matter, did it? So what happened? Your EPS grew over the next 3 years at 57% CAGR, which means the EPS more than doubled, close to trebled. And the stock went up 4 times between March 2010 and 2013. And mind you, that was a bear market in India. That was before we had the new BJP government. That is when Indian PE ratios were very depressed. And there was a lot of political trouble in India back then. You had a stock treble over 3 years. Starting point PE ratio 60. So no better demonstration for why earnings acceleration matters. I can tell you pretty much any company that is a leader that had this nature of earnings growth had a very high chance of doing this, no matter the P ratio. Because most people cannot forecast these earnings. But if you're in the leader and the earnings are growing, you stay invested, you have a good chance of success. Second, so let's pick some other examples from this. If you look at, say, Avenue Supermarts, why am I picking Avenue Supermarts? It had that criteria of newness. It was a new IPO. India didn't really have many, other than Future Retail, we didn't have any listed grocery retailer in India. Leader with leading metrics, new IPO, I think this was 2017. Despite an initial PE ratio on listing day of 83 times, the earnings over the last 5 years have compounded 25% CAGR and the stock is up 6x. So I think the story here is very clear. The point we're trying to drive home is accelerating earnings leads to wealth creation as long as you're in leaders. And I think this is for all these other examples. I can go into grave detail for all these other examples here, but I think 2 examples are enough. And pretty much most of these companies, starting P ratios were high, reasonably high to high, and you made tons of money thereafter. Wealth was created, meaningful wealth is created by investing in companies where earnings are growing. Yes.
Now, in your example, the third one,
yes.
Relaxo Footwear.
G.
How would you compare this stock with Bata, which is a more stable brand?
Yes. So, if you see the difference between Relaxo Footwear and Bata, now I know a little bit about Bata, so I can tell you it's a leading franchise, but the earnings has not been growing. There's been no earnings growth in Bata. Okay. So one has to sit back and make a case for earnings growth. Today, can you make a case that Bata earnings can grow for whatever reason? Are they investing? Are they opening new stores? Check their store metrics. Check their realization per pair. So some work needs to be done. Basic work needs to be done, right? Okay. Now, again, a Relaxo Footwear, earnings have been accelerating at a rate which is very elevated. Stock market is attracted to that, which is why you made money.
But sir, again, you discussed sometime earlier regarding whether this earnings growth will be stable or not. So how can we adjudicate while, presume when you are making a buy, whether this particular stock will have a continuous upside in earnings?
See that, so, I'll tell you that that requires some research, right? That requires a little bit of hard work and research. See, I would go back to this point. When you look at, these are examples where we'll try to answer some of your questions in examples, but directly to try to answer your question, when we look at current big or accelerating quarterly earnings and sales growth and annual earnings increases, many times, at least I can tell you how we have been able to identify these stocks. What we have been able to do is look at the past earnings track record. So if you look at Bata and Relaxo during that period, even the 3 year prior or the 6 to 8 quarters prior was completely different, right? So most of these stocks that come up on our screeners, so to speak, for the lack of a better word, their earnings growth is already accelerating. They have already been growing in an accelerated manner. It's not that we are saying, oh, from today it will grow. The growth is already there. It may just not have been identified by the market or partially identified. I'll tell you, when we say first bought relax, so maybe it was already up 10 times from the bottom, but it still went up 6 more times from there. You don't have to be the first guy identifying it, right? Now, so I hope that answers your question.
Okay.
Yeah.
And
What
supposing if we see only
Ketan, we'll have a question answer session later.
Okay.
Let's let the speaker go on.
Yeah, I'm happy to answer all questions after. Yeah. Yes. So I think I'm just going at this stage, right? Before we get into, see, these are live examples of certain things that we spoke about earnings acceleration. But before that, I'm just going to take a second to summarize what we have said. So earnings acceleration is very important. We've talked about this. You have to look for accelerating recent, as I told you, recent, and evaluate the future earnings growth potential. It is up to your research skill over here, right? Stock picking is about your skill. The P ratio we have mentioned, and we've tried to demonstrate why it doesn't matter as much as one thinks, so long as the earnings are growing in an accelerated manner. The third thing we said is never forget that it has to be a leader, right? You define the leader, right? Whether you like high ROE companies, it has to have a leading a good track record, right? For us, leaders are these kinds of companies where there has been some element of track record, demonstrated delivery over long periods. Have they done well during a cycle? Have they kept a lean balance sheet? They've not borrowed too much money to grow. These are leaders. The balance sheet will answer many questions. I can generate a very reasonable to high ROE without investing too many dollars, even if I'm not growing. Not every company grows all the time. Like, for example, the companies that we gave you examples of, the growth is not forever. They cannot grow like that forever. They will grow like that for 3 to 5 years, maybe 6, 7 years. But beyond that, it tapers off. So leaders are important. You have to look at companies, even through down cycles, maintain their balance sheet, even through down cycles, maintain a reasonable ROE, maintain a cash position. All this is very important. Industry strength. This is something that I didn't touch upon earlier, but it's similar to that point of institutional sponsorship. Be in the right industries. Don't pick laggard industries. There are just some industries that are bad. They don't create wealth. They run on debt to equity ratios. They run on bank money. They're very high on capex. Now, you as an investor, again, you have the buffet. You go to the best, most dish that you relish. No, why choose something that looks like it may go up or may change in the future? Look, you need to join a moving train. Work on or identify what's already moving. Something that great investors are already invested in. Institutions have a flavor in that sector. So we believe industry is very important. Stick to leading industries. So I think, and one last point over here is that, yeah, I'll move on now to some live examples. We've just put together some examples of, things that we have seen in the past, especially in the last 10 years, because there's some recency in these examples. Some of these names have been wealth creators. And I think what we are trying to demonstrate over here is that as long as the earnings accelerates, the starting P didn't matter as much. As long as the earnings accelerates a lot, you can get price earnings expansion. Thus, you can get benefits of earnings growth and price earnings expansion, thus wealth creation. Max wealth creation happens when both these combine. So let's look at the example of Eicher Motors. We're talking about a period from September 2010 to September 2017. This was a period where the EPS went from close to 6 rupees to close to 70 rupees. The price earnings ratio was 21 times then, and it ended up at 45 times. The price went from 122 rupees to 3,100 rupees. So as you can see, substantial wealth was created, right? Now, that resulted in a 42% CAGR in EPS over this period, resulted in a 25x stock price expansion. What happened thereafter is very interesting. And I think this talks to the point that leaders don't always grow. You cannot have such growth forever, right? When the growth stops, the PE expansion stops. Even in the best companies, because they are large, they're leaders, they're well loved, they're well owned, People don't. Strong, large holders don't dump these shares. But you may not make money for a period of 5 to 7 years. Look at Aisha. It's a great example of that. Look at the earnings per share. It is virtually zero growth in the last 5 years. The chance of the stock price going up during this period is very low because your starting PE ratio also is very high. So you have to be able to identify these trends. You have to look at things that are happening in the company. You have to understand the industry. You have to understand the company. You need to do research for this. This is very hard to do. You cannot time it perfectly. You're never going to be buying at the bottom, selling at the top. Maybe you'll catch some of the move. Maybe you get it wrong at the top and you have to take your losses also. Anything can happen. This is just an outstanding example to show that if the earnings are accelerating, there's a very high chance of wealth creation, right? And when the earnings stop accelerating, you can get essentially no results for a long period of time or even meaningful wealth destruction. So I think this is a very similar example. And now that I've shown the last example, I can quickly tell you over here, the earnings expanded close to 7 to 8 times, but the stock price expanded close to 20 plus times over a 7 to 8 year period. It was meaningful wealth creation. And then the stock did nothing for about 4 years from 2018 onwards. It was also, no coincidence, very limited earnings growth. It was nothing compared to in the past. So what could have happened? People's expectations could have been wrong and very high and were not met. So I think that this is another example to tell the same story. We've used a third example over here of IndusInd Bank where, the book value per share over here in the case of banks, people in the stock market tend to use price to book ratios rather than PE ratios as a way of evaluating banks and the banking sector. But large compounding in price to in the book value per share, and the stock price reacted similarly. This is a good example because the price to book was close to 4.5 times, and it almost held that through this period of earnings or price to book growth. So wealth was created, elevated multiples stayed elevated despite the stock price going up 7 times. You had decelerating earnings growth from 2018 onwards, and see what happens to the stock price. So I think that these are just 3 examples. There are hundreds of examples like this. The point that we are trying to make is that you have to be watchful of decelerating earnings growth and make sure that if you want to make substantial amount of money, you need to find these winners and where the earnings are accelerating quickly. Just another quote that we'd like to share. I think importantly, we'll talk a little bit about risk management, on what not to do and where to be careful. So again, this sounds rather simplistic. I mean, there's a laundry list of what not to do. I'm not getting into forensics. I'm not getting into various points other than what our focus for this presentation is. But I think it's very important to highlight the first point, because since the focus of this presentation largely is earnings acceleration, and don't be fooled by the P ratio. Don't just buy blindly and hold at any valuation without making sure there is earnings growth. The underlying earnings growth, I can't say this enough. The underlying earnings growth is the single most important criteria for a stock price to go up. And I will share a couple of examples of this. A favorite example of ours is what happened in Hindustan Lever for almost a 10-year period. You had zero stock price appreciation. Everything was right. Great company, great ROEs. But does an investor have the patience to sit through 10 years of pain? Most people will get into this trap and sell their lever at the bottom, and they wonder why they ever bought it, right? And there's only one correlation here again: no earnings growth, right? You could have bought at a high P, but you don't get earnings growth. You're going to get massacred. Your capital will do nothing for you, and you will make absolutely no money. And 10 years is a very long time, I promise you. If somebody tells me they're a long-term investor and they have patience no matter what, then God bless them. But your money could have been doing a lot for you during that time. Of course, what happened to Lever after that is an amazing story. 2011. So Lever's starting valuation was very high in 2000, I must tell you. It was a 1990s, 1990 to 2000. I wasn't here in India. I wasn't in the market, but I'm told that it was a decade of a lot of FMCG stocks getting re-rated. So valuations went very high. Earnings was growing. Then there was no returns for 10 years. But then from 2011 to now, it has been a stellar performer. It has, I believe, gone up, yeah, here 10 times. What does that mean? 7 lakh crore of wealth created in 12 years. 7 lakh crore. Because the market cap, I believe, is 8 lakh crore today. 7 lakh crore. Well, why? Because the earnings went up. Today, Lever makes close to run rate of 10,000 crore in profit. So his profit went up 4 or 5 times. And in 2011, every sell side analyst had a sell on Lever. I can tell you, because it had 10 years of no performance. So to your point, picking that inflection point is very important. Another example, I think Reliance is, of course, well known to all. It again had flatline returns for a very long time. I can tell you a lot of this period from 2013, 14 to 17, 18 was when they were investing in Geo. They were borrowing tons of money. Questions. I mean, now I'm talking to Bombay Chartered Accountants Society. There will be lots of people who will say, oh, the forensics of Reliance. But look, I mean, I'm not going there, because Reliance for me has been a delivering company for the last 40 years in India, right? It's created more wealth than any company. So let's not question them. They know a little more than us. And I think 10 years of flat returns in Reliance is very painful, right? When you buy a blue chip company, a leading index stock, you don't expect to make no money for 10 years. It's painful. It's very painful. The point is, once Geo was done, once it was launched, once all that capital work in progress was capitalized, once all that debt started getting repaid, the cash flows started getting generated, the stock did this, right? So Reliance earnings have expanded since then, but they weren't growing for a very long period. So long periods of pain here. So this is an example. This is what we tried to tell you about. Don't just blindly buy and hold at any valuation. It is a silly thing to do. It is a playbook for what not to do. Right? If the earnings aren't growing, just don't be in it. It's not wise. You could get stuck for very long periods of time. Again, we've talked about leaders and not buying non-leaders. We love to focus on leaders. What we do at Girik, we ask ourselves, right? Okay, this looks so attractive. There's a chance of making 3 times the money here. This stock is, earnings are going to grow. We come back to one question. Is it really a leader? Is it something that a risk that we can take in hard-earned investor portfolios where they've given us some money on a fiduciary basis? Can we buy that second-rate stock just because we think it would be a quick double? A big mistake. It never happens. It rarely happens. If it happens, you're lucky you will not get stuck once, you'll get stuck the third time, right? But don't buy second-rate stocks. Don't buy non-leaders. And again, this is not personal. This is not naming and shaming anybody, but just examples of, in a particular sector, where there's been a great winner and a great loser. Many times we heard in the last 10 years, oh, Titan, wow, right? We all know Titan, great company, compounding machine, leader, owned by the Tatas, and the earnings have been accelerating. It's so tempting when you see Titan trading at 2 lakh crore market cap to go and buy a recently listed jeweler who says, oh, even I'm going to grow 30% per annum. It's not so easy. So avoid this trap, right? This is another playbook for what not to do. You can really get stuck and erode your capital. You may get short-term pleasure and thrill. It's not worth it. I'll tell you, this is one of our favorite examples on what not to do. Again, talking about leadership. There's only one DMart, gentlemen, ladies and gentlemen, only one DMart. There has been no other grocery retailer in India with the kind of metrics of a DMart. There may be in the future, but it's very tempting when you see a DMart listed at a market cap of 20, 30, 40,000 crore to go and say, oh, what about this guy? What about a future retail? They've been lying around for a while. They have so much turnover. They are showing so much profit. But if you just do the homework there, you'll see they were not efficient users of capital. They were not a leader. You don't go buy the second best when the best itself is growing its earnings so much. It's again the Malabar Hill example, in a sense. So I think these are 2 examples of why one should stick to the leader and not go for second-rate stocks. Again, playbook for what not to do. I think the third one for me is one of my personal favorites. I mentioned one thing. I said, we are wrong half the time. Where do we go wrong? Sometimes in identifying leaders, you think a company is a leader or it may become a leader, but you say, it doesn't. It actually doesn't meet your goals and expectations. You think that the earnings will grow, but you're not. You're not champion. You're not God. You can't forecast all the time. You can't get it right all the time. You will get it wrong. The question is, how do you identify your mistakes? It's very important to don't stubbornly hold on to your losers. If you are losing money in a stock, whatever your reason might be, you've done the research, you've done the homework, the earnings growth isn't coming. Or the company's made a stupid acquisition and the price is down 30% from where you bought it. It's very tempting to go on average. Just because it's fallen doesn't mean it's cheap. Just because a stock is down 50% from top, it doesn't mean it's cheap. It's very important to go and recheck the fundamentals. So, we've used a couple of examples over here. I mean, I wouldn't say these are great examples because we never considered these stocks to be leaders. Here are the examples. Sorry. Oh, sorry. Yes. So, I mean, point is you can erode a lot of wealth by thinking, by averaging down. It's very tempting when something was trading at 400, then 200, then 100. I mean, there are a gazillion examples of stock prices going to zero or doing nothing for the rest of your life. Important not to just make the mistake of constantly averaging down. Other examples. So idea is don't just create wealth, preserve it as well. By doing stupid things, you can destroy it. So stupidity is, something in abundance. It's better not to, you even do one does basic things right, buys and holds basically, sticks with leaders. Over 10, 20 years, you'll be fine. Just don't buy bogus, Don't go and make those mistakes just because you got a tip or because you think you're over smart. Keep it simple. So I think in conclusion, would like to say that, again, reiterating the same points. I mean, it's really, we try to keep it very simple today. Focus on the earnings acceleration. It creates maximum wealth because this is what we are all after in our portfolios, right? I mean, if you can't do the research, you don't have time to do the research, go to a leading mutual fund, right? They do good work. Go to a professional manager who does good work and stay invested for long periods of time. Continue your SIP because it's not necessarily easy to do what we are saying, right? It looks really easy on paper. It's not so simple. Focus on leaders, leading industries. I can't emphasize this more. Don't just stay away from everything that's B grade. You're going to destroy your wealth. And there's no substitute for this. I think our big learning is when you're right, make sure you maximize it. Even the great Rakesh Jhunjhunwala, if you look at his portfolio, it's made from 2 or 3 companies. Many of his portfolio stocks have been losers. They have been wealth destroyers. And you have found that bulk of his earnings or his winnings have been made in just a few stocks. So when he was right, he made very big gains. But when he was wrong, he lost very small. He was able to ride his winners. So I think this is another big learning. One great other point is we made is don't let your losses run, right? So cut your losers, identify your losers. Don't make the mistake of averaging down. And I'm going to leave a great example here. I think something very interesting, and hopefully this is insightful to everybody. The Nifty itself doesn't hold its losers. The Nifty, we all think is a passively managed fund. It is one of the most actively managed funds. And it actively manages lakhs of crores, more than any fund in our country. And it buys and sells stocks in lakhs of crores, right? And it does it mercilessly. If the price goes up, it buys more. If the price falls, it sells or it downweights. And I will show you how. So this is an example, 2000 being the starting point. Look at the weighted changes from 2000 to 2022. I'm looking at the left side of the page first. Exclusions, reductions in weightage. Lever went from 14% to 2%. Nifty cut its loser. Reliance Petro out. Satyam Computers out. Ranbaxy out. NIT out. HPCL out. Where did that money go? It went into winners, stocks that went up in price. It went into HDFC Bank. It went into Titan. It went into other companies. The right side shows you how weightages have increased. Money went into Reliance. Money went into ICICI Bank, which wasn't in the index back then. Money went into HDFC Bank, which was 1.7% of the index. The index is an active manager as hell. It's constantly redeploying its capital. And based on what? Zero research. simply price. What goes up goes back to this. The Nifty really believes this. Why don't we? Why does it usually go higher? Nifty is a firm believer in this. So these are the big changes from 2000 to 2022 in the Nifty. Huge changes, rather. If you look at some more from 2009, which is more recent memory to all of us, ONGC virtually gone, Pale gone, Arcom gone, Reliance Infra gone, Sterlite gone, but Sterlite is there in the form of Vedanta. DLF gone. Some of these were darlings, but the Nifty sold them. And you know what? Those stocks have done nothing. All those companies have gone bust. And where did the money go? TCS, Kotak, Bajaj Finance, Asian, Adani, IndusInd. So Nifty did its work. It did its work at the push of a button. And the interesting thing is, and I will leave it with this, that every one of those companies that was excluded, the earnings decelerated. And every one of those companies that was included in the index, the earnings accelerated. So it just shows and goes to prove that if the Nifty is doing it, why can't we? So I think, ladies and gentlemen, with that, I broadly come to the end of this. Yeah. I'm happy to start answering questions and get into detail.
100 people. 100 people.
Wonderful.
So anybody who has questions can either, virtually put on the Q&A.
First, we'll take up from physical.
All right. So we'll first take the questions from the physical audience here.
Yeah, sir. The one question on earnings.
Yes.
Supposing if certain companies give you exponential sales growth, but barely they are just in the incubators and not even have crossed the turnaround stage.
Yes.
So what about investing in those?
So okay, thank you. So that I understand your question. What you're saying is that if the sales are growing exponentially,
Correct.
and the earnings are either in a loss or
Yeah.
they are not growing at all.
Correct.
Would you?
Means there would be positive cash flows,
Yes.
but not positive earnings. Means there is
positive cash flows. Yeah.
Yes.
So, when I use the word broadly earnings, if you have positive cash flows, that's a great substitute for earnings. I mean, if you have accelerating cash flows, it's even better than accelerating earnings, right? So many times what you had, I'll give that example of Jubilant Foodworks that I gave. If you see the PE ratio was very high, but the price to operating cash flow, that is after changes in working capital, but before CapEx, as we look at it in the stock market,
Okay.
that rendered the price to cash flow ratio much lower because it's a business that actually works on a negative working capital cycle.
Okay.
So, they actually pay the trade maybe 60 days later, but they collect money from, as a restaurant owner, they collect money cash down.
Okay.
I mean, that's a lot, right? When you're doubling your sales every 2-3 years,
Correct.
that's a lot of negative working capital that you're sitting on. So your cash flow generation is very high.
Okay.
So I think that, yes, that's a very fair point on your part. I think what you said is very right.
Okay.
If you have accelerating cash flow growth, it's a superb substitute for the PE ratio.
So
You
take
have-
examples like delivery in transportation and logistics. Yeah, there are major brands here.
Yes.
But if you see the components of earnings, when you say about the losses turnaround, etc., and the growth in sales of the top lines are much more superior to the established brands.
The losses turnaround.
And the growth in revenues, the top line,
Mhm.
as you call it,
Yes.
they are much more superior
Yes.
in terms of percentage growth
Yeah.
when you compare with the established brands,
Yeah. See, that
listed brands.
it's a very fair question to ask. I mean, so I take your point on the first thing where, if they are generating cash flows, wonderful. That means they're surviving on their own generation, no? I think what we like to focus on is companies that are surviving on their own cash flow generation. If you're going to rely on external capital to grow your sales, that's a problem. That really gets a multiple in the long run, right? The chance of capital erosion is very high. It won't meet your leadership criteria then. right?
Okay.
So look, we are playing here with more established businesses. The startup world is a little different. They do it their way, you know.
Okay.
The startup world does it their way. We do it a
Okay.
little differently, I must tell you. So in that sense, we are more conservative,
Right.
which is fine. I mean, I think within our conservative bias, we find enough investment opportunities, you know.
Okay. But sir, certain startups like Persistent Systems, etc.,
Hmm.
are have delivered fairly superior returns over the last 1 or 2 years.
Yes, yes, yes. Is it a startup? Persistent, I believe, if I'm not mistaken, was listed almost 14 years ago, or no, 12 years ago.
Okay.
So I don't think it's a startup.
Okay.
Yeah.
And the turnaround happened in the last 2 or 3 years.
It's possible. It's possible. I'm not very familiar with that name, especially what happened recently.
Okay.
So I wouldn't really be able to precisely answer that question. But
Mm.
yeah.
Okay. Okay.
Uh,
Why company splits the share? You say supply is a thing, of course, doesn't increase, but what is the logic of splitting and then the price?
It's highly stupid if you ask me. I mean, I don't get it. I don't understand. You know, I'll tell you, just to make a share cheaper and more accessible to retail, if you think you're being shareholder friendly, na, you're fooling people. You have to deliver shareholder returns through dividends and stock price appreciation backed by earnings and cash flows. That your job is that. Worrying about the stock price is secondary. I think these splits, I mean, many times I found bonuses are done for the wrong reasons, like tax reasons. Yes, sometimes there are genuine reasons, like you have to capitalize reserves. I can understand that. But a stock split in general, we view with great circumspect, you know. I mean, Warren Buffett has never split his stock, by the way. It is still trading at lakh, 2 lakh, some crazy dollars, right? I mean, he's never bothered. He's like, if you want to buy it, you know. And yes.
Whenever there has been a growth in the retail participation, where small investors, if you see post COVID, and there has been a lot of investment happening from small and middle class families and salaried individuals coming into the play. So the stock split has generally been a tool which has been considered by companies to make their stocks a
More
little
affordable.
afloat in this retail industry.
You mean more affordable?
More affordable, so that they also have a participation of entering a large ticket stock.
So if I understand your point correctly, if a stock was 1,000 rupees and I split it 10 for 1, now it's 100, right?
Yeah.
So buy one share, right? You don't have
That
to own
doesn't
10.
give the satisfaction to the small investor.
Yes, I mean, I generally think, yeah, optics are a little,
It's
I
more
mean,
about
you know,
optics.
I guess I'm very traditional in that sense. I don't believe in this, I think it's not necessary. Yeah, sometimes, yes, maybe. Look, one more reason would genuinely be if you want to increase liquidity a little bit.
Yes.
It can be done if the stock is very illiquid, possible. But I generally don't buy those reasons. In my opinion, that has very little correlation with long-term delivery of shareholder returns.
Right. Sir, one question. When we see our, especially from the end of COVID, you're from March 21. How do we pick up stocks or industries? When you say about earnings, when we say about acceleration, how do we pick up stocks in a hyperinflationary economy? Because we have seen the inflation going up, like crazy. There has been a lot of changes in the prices of steel, cement, and all your base products or commodities.
Very good point.
So how do we select the right industry and the right stock in
Yeah,
that?
I must say it's a very good point. I must tell you one thing though about India, right? I think we have been born with inflation. In our country, if a salary was 100 rupees 20 years ago, today it's 2,000 rupees. We are born with 7% inflation. So India, I'll answer your question more directly, but I'll just try to say why the stock market, that even makes the case for investing in businesses or in companies even more compelling. Equities is an inflation pass-through, right? In India, everything inflates. Salaries inflate, your office rent inflates, the cost of my clothing, maybe not because of scale, but in general, most things inflate in price. There's a general inflation rate of, I think in the last 20 years, maybe 4 to 8%, right? So pricing, badega. What is a business? What is a good business equipped to do? Because look, because it has good products, or because it has a good grip on its customer base, it provides a value added service, it has the ability to pass on pricing. So naturally, what it does is you have not only inherent volume growth in India. India is blessed with inherent volume growth, right? Our GDP grows at 6 to 7% per annum. Volume growth plus inflation growth, right? And a good business is continuously working to optimize cost structures, constantly looking at MIS, saying, cost kaise improve karo? How do I negotiate? As I get bigger, my ability to negotiate gets harder. So not only am I able to slowly pass on my price increases to customers, I'm also able to optimize cost structure. So I can deliver earnings growth higher than top line growth, hopefully, over long periods of time. So I think you have to look for that leader, that quality business, right? That has the ability to pass on. That's the important takeaway here for me.
So when we look at our industry,
Yeah.
when we distinguish our market into different industries, where we have noticed that some of the industries, the cost have been able to absorb that inflation and sail on, whereas few industries, they have they have been beaten up very badly.
Yes.
For example, your renewable energy industry, your power sector, which are very capital intensive, and especially because of the base metal prices and the commodity prices going up.
Yeah.
So how do we gauge that in the while selecting the stock? For example, today if we see TCS, Kotak, Bajaj, Asian Paints, and Adani in the top 6 inclusions in the Nifty,
Yeah.
whereas when we see the Ukraine war continues and the cost of oil going up
Yeah.
because of Russian supply issues, which is a very detrimental factor for Asian Paints,
Yes.
then how do we analyze and discount that when buying our
So
stocks?
it's a great question, I'll tell you, but now we are getting into very idiosyncratic. Like every business will be affected differently by different inputs. Now let's take example, Asian Paints, great example. Crude oil dependent, right? Can't pass on immediately. If crude oil, if its input costs go up by 20%, it will not raise the prices by that much, right? It's a market leader, it's going to keep its market share. In fact, it'll probably keep its market share at that level and not pass on just to kill the competition, because it's very large. It has the ability to do that. It has a cash-rich balance sheet. It's a leader. That's a leader, right? That's why you stick to leaders. One, it could also mean that for the next 2 or 3 years, you have zero returns because you have no earnings growth in Asian Paints, because it's just absorbing that. And slowly, smartly pass on, change the volume, change the size of the pack, change distributor terms. ऐसे निकलेगा आपको पता ही नहीं चलेगा. And all of a sudden, you'll find after 3 years, खट से earnings growth आ गई. I mean, I've just tried to use an example. It's always a good,
That I think answers all my
So
questions.
that's been my experience with inflation and why these companies always come back, the great ones, But remember, you have to sit through certain periods of pain. You are right. If this Ukraine war just goes on and the price of crude keeps going up to 200, you may have to wait 5 to 7 years. Maybe that's what happened to a lever for 10 years, right? So you have to balance these things. These are things to keep an eye on. Valuations are important. If you're sitting on high valuations and no earnings growth, you're a sitting duck. You can't pay 60 to 80 times earnings for a leading stock and it have no earnings growth for 5 years. You're not going to make money. You could destroy wealth. So these are things to consider. One presentation can't answer everything, but I can try to tell you basic things from my own experience and Girik's own experience.
Thank you very much, sir.
Sir, yeah, alternate
Sure,
one
please.
or couple of questions from the
Of
virtual. Piyush Agarwal wants to know that if we are so much positively biased for market leaders, then does it make sense to buy mid caps or small caps?
Does it make sense to buy mid caps or small caps? I'll try to answer that question in a simplistic manner. There are also market leaders in the small cap and mid cap space, right? Many of these companies where we gave out some examples were also small caps when they were listed or when they were first identified. So it doesn't mean that leadership is large cap. Leadership could be good quality small and mid caps also. Broadly, in amongst the investment community, there are close to 300 to 500 companies that are investable or broadly seen as investable. Maybe half of those are leaders. Not all are large caps, right? Because there are only 100 large caps in India. The top 100 are large caps. Everything outside is not a large cap. And many of these graduate to moving into the top 100 over time.
Right, right. Unicorn businesses,
Yes.
which trade at very high premium,
Right.
versus the traditional stocks
Yes.
which are beaten up by merchant bankers? What is the logic behind that?
You know, I'll try to frame an answer for that. It's a very broad question, I must say. You see, one must see a business for what it is. Don't call it unicorn or traditional, right?
Ah,
We have seen traditional businesses like a food retailer or grocery retailer. So was a DMart at listing a traditional business, or was it a unicorn? Call it whatever you want. It grew its earnings 5x in 7 years, 5x in the next 5 years. What are we concerned with the result? Who cares if it's a unicorn or not? Who cares what we brand it, right? Ultimately, if the earnings are growing, if the girl is beautiful, the suitor will come. You know, it's very simple. अभी वो unicorn में उसको unicorn बुला लो या जो बुलाना है बुला लो, वो unicorn को का earnings grow करना चाहिए, तब पैसा बनेगा. That's our concern, you know.
sir, Pietro. Acha. Ah. Oh, so we'll take one of, yeah. Yeah. So two questions here
Sure.
by Niranjan, and both of them are very relevant to the discussion that you made, sir. How to cut the losses? That is, how do we really identify that this is the point at which to exit to cut loss? And second, what should be the basis to book profits?
Right. Toughest question I've got today, right? Because even I don't have the answer to that. There is no right answer for these things. Because if there was a simple formula in investing, it would be so easy, right? I must say that over time and over doing this again and again for 13 years, this method evolves. Okay. One thing I can say when it comes to risk management and cutting losses, it's very important. Whatever thesis you build, you did your research, you studied a company, you studied the fundamentals, you said, yes, the earnings can grow meaningfully over here. This company is a great leader. You have to have a good grip, because we are talking about individual stock picking here. We are not talking about buying a mutual fund where somebody else is doing the work. Remember, here, you are doing the work. You're going to have to be on top of that company. I can't do that for you. I can do that for myself. I can do that for my investors. But if, say, for example, Sun Pharmaceuticals, I'll use this example. Okay. 2015, 7 years ago, this stock was booming. There was a huge euphoria in pharma. A lot of assumptions were being made at that time about how the pharma sector can grow its earnings in a meaningful way. And this is the decade coming of pharma. It didn't quite work out like that. How would one cut their losses at a time like that? I can tell you that, see, there are two schools of thought here. If the earnings continue to disappoint, if the earnings don't come through, you give it a finite period of time. This is one way to do it, and you cut your loss. Many people prefer to do it with a price discipline and say, oh, look, if my stock hasn't performed for a certain period of time, I get out. Or if my price is down from where I bought it, below a certain level, I get out. You have to do it your way. I would say that it's very important in this method that we are talking about. It's not a one size fits all, right? We mostly focus on accelerating earnings. If earnings are decelerating or not growing as we anticipated, we are very cautious and careful to make sure we don't let capital get destroyed. We want to be in the best leading growth stocks. Earnings growth results in meaningful gains as we keep talking about it. And I think that's what you have to keep your eye on.
Yeah. Sir, and
I think
for
there was
finally,
a second part to that question, which I did not answer.
when to book profits?
Yeah, when to book profits. Again, as hard as the first part, but I must tell you that how do we do it? In general, as long as the earnings are accelerating, you don't get out. It's very tempting. A big mistake one-on-one is to sell early. I double my money, I get out. You don't do that. Had you sold any of these stocks, you got the buy point right, and you sold any of these stocks too early, can you imagine how foolish you would have looked or felt, right? If the earnings was growing and the EPS went from 6 rupees to 68 rupees, The earnings was growing all through this period. The stock price kept appreciating. Don't sell early. That's one thing I can tell investors and share with them. As long as you have accelerating earnings growth, stay the course. You've got the buy point right. Stay the course. Ride your winners. Over 5-7 years, wealth can be created.
Wow.
So I think that selling too early is a bigger mistake. One of the biggest mistakes people make in investing.
Right. Sir, and for all those for whom all this may be overwhelming, and someone may think that I want to go for a passive investment strategy.
Right.
Are there any suggestions for what could be the one of the most passive investment strategies?
So the most passive investment strategy, passive active, according to me, passive is the Nifty. I must say that at the end of the day, I explained in this presentation what the Nifty does so beautifully.
Right.
For any investor that wants a low cost, passive way of investing money, you invest in the Nifty, do your SIP there, right? There's no human intervention and it has performed for decades. There's no reason it will not do it again. You pay no fees. It's free virtually. And it cuts the losers and it adds the winners. And it has a method for that. Is what we're trying to stress. Have a method. Whatever your method is, be consistent. Ultimately, that wins in the long run. And the Nifty does it beautifully. So it's a brilliant way for investors to ultimately grow their capital over a long-term FD rate. And in a tax-efficient manner.
Perfect. Perfect.